It's time to spotlight several bullish and bearish picks. Joining us now to do that is Tony Zhang, Chief Strategist at Options Play. Tony, thank you for being with us as always. Let's just kick things off right away with your first one with Meta. You're bullish on Meta. Walk us through why.
Yeah, this is a stock that I've been bullish on for quite some time, but over this year, the numbers haven't looked so good. But recently, we're trading at around 24 times forward earnings, and I think it's time to look at Meta again because I think the risk reward looks quite attractive here. The AI models that they've been working on for the last couple of years are starting to show some improvements in terms of lifting ad revenue. So, we've seen about 3 to 5% increase in ad revenue from the AI models that they've introduced for advertisers. That's a really strong growth from a margin perspective. We're seeing net margins now north of 40%. So, that's going to pay for their, 60, $70 billion a year of capital expenditure for building out AI infrastructure. And I think that's really one of the biggest things that investors are concerned about is how they are going to pay that back in the long run. And, the recent announcement of how they're going to integrate AI into their models and their agents, I think this is really, some of the answers that investors are looking for as to how consumers are going to essentially be monetizing the AI infrastructure. So I think at 24 times forward earnings, that looks incredibly attractive given the profit margins that Meta still commands. And then the recent news about the smart glasses, I think this could be a pivotal moment in terms of, when we look at smartphones and how that took off here. I think smart glasses is clearly the next trend, and Meta seems to now have leapt ahead. Apple, with a Vision Pro from a commercial basis of these wearables. So I think Meta at 24 times forward earnings looks incredibly attractive, and the recent pullback, into the low 700s is a good entry point for traders.
And yeah, so that pullback makes it attractive. And you mentioned some of these AI, interactions and how they're going to contribute to, ad revenue here. But how important is this continued push into AI for Meta and this continued CapEx spend to their story in terms of them moving to the upside and being less choppy?
I think it's the whole story, to be perfectly honest. I think at this stage, they have to spend this type of capital expenditure to compete in this particular space because the computing requirements of AI and the needs for it is going to be incredibly strong. And at this stage, firms that are not spending this type of capital expenditure clearly will fall behind. And Apple, for example, is one of those firms that is already falling way behind on this particular front. And that's why I actually think Meta is likely going to leapfrog Apple on this front with regards to smart glasses, even though they don't have smartphones.
Yeah, I did see some reports this morning saying that Apple is going to move quickly into trying to enter the smart glasses space because of Meta's dominance. But I would love to get your thoughts before we move on to your next one about Meta's deal with CoreWeave and sort of how that plays into their AI CapEx spend picture.
Yeah, so I think from an acquisition perspective, a lot of these firms are going to be looking at acquisitions, and deploying capital not just through infrastructure spend, but through acquisitions. And I think CoreWeave is going to be it's hard to I would say opine as far as how strong that's going to be in this space for Meta. But just because the space is evolving so quickly, I think it's really hard to say whether or not this is going to be a core piece of their business in the long run. But acquisitions and capital expenditure is by far what is probably going to be most important in terms of dominance, and which is why you're seeing Alphabet, Meta, Amazon, Microsoft, all of these firms spending north of $50 billion a year in capital expenditure for AI infrastructure, specifically because if they don't, they are going to fall behind.
All right, your next one that you're also bullish on here, a sector we've been talking about quite a bit the last couple of days in healthcare. This is Elevance Health. What about them is constructive to you? Why are you bullish here?
Yeah, so your previous guest actually just laid out a thesis for UnitedHealth, and Elevance is essentially the same proxy to that. The second largest in this particular space. The chart looks almost identical to UnitedHealth. The prospects of the business looks similar. They both went through the same pain points, if you will, over the last couple of years. This is a stock that essentially halved in value in the last year. But recently it bottomed around that $300 level. It's moved around 20% off of the lows in the last couple of months. It's showing some signs of recovery, trading at only 10 times forward earnings. I think is looking incredibly attractive from a valuation perspective. Cost has actually really been the biggest driver of the stock performance over the last year. And this is something that in 2025, they seem to have finally hit a bit of a reset button on everything with regards to rising cost. And, Elevance has the Caleron business that is now growing pretty substantially. We're looking at north of 50% year over year growth in terms of revenues from that side of the business. And I think that is likely going to offset some of the margin compression we've seen here for Elevance. So if you look at the chart, it clearly is showing some signs of recovery. The fundamentals looking like it's starting to stabilize. And I think for those reasons, I like this stock, especially given the overall sector trading at one of the lowest valuations we've seen in the last couple of decades. Just from a valuation perspective, looks quite compelling.
I was looking them up ahead of our conversation and saw that they're in the bottom 20 in terms of PE ratios of anything traded on the NYSE. So a very interesting one here. I do want to ask a question about their earnings before we move on to your last pick. For Q3, they're coming up October 21st, but expecting profits to be down 40% from the year ago quarter there. In terms of, how you play this one or any concerns there in terms of this being a bullish pick, do you think that that's just expected at this point and you remain bullish, or you have concerns there?
That's definitely expected, and management guided, lower on Q3 earnings last quarter. So to some degree, that is expected, and that's what I was referring to in terms of 2025 is them resetting the decks on where the business is, and investors at this point is hoping that. This is the stabilization, and this is kind of the bottom, and this is where we start improving from here. But that doesn't take away from the fact that 2025 is a year that clearly is an issue for them from a financial perspective. But despite the significant decline in revenues, they've continued to commit to returning capital to shareholders. We're looking at about $2 billion being returned to shareholders in the form of dividend and share buybacks. And I think for that, shows that management is at least confident in their outlook for 2026, and that is not going to deteriorate further, is the way that I'm reading that.
All right, so let's move to your last one. You're bearish here on CZRs. CZRs we saw last month get removed from the S&P 500 index, added to the S&P Small Cap 600. What are your thoughts here?
Yeah, this is just a business that's overall struggling on all fronts. We know that visits to Vegas has been relatively soft this year. There are some signs that maybe that picks up towards the second half of this year, but so far that hasn't really materialized. In terms of the digital business of online gambling, they're seeing some early signs of growth there, and the growth from a percentage perspective looks strong, but if it's coming off of a really low base. So, this is a company that earns nearly $1 billion a year. In terms of growth of digital, we're only talking about $30-40 million. So it's not contributing a huge amount to, top line growth here. So when you look at just the business, it's not growing, it's not profitable, it's trading at 35 times forward earnings. And this is a stock, if you look at this chart, it clearly shows that investors are they're not there are no signs that this is recovering. The recent rally here into that $27 level a couple of days ago clearly got sold off very heavily as soon as it kind of rallied. And I think that's a sign that there's likely further downside ahead.
All right, well, Tony, we appreciate you being with us today to break down a few of your bullish plays and a bearish play for us as well. That's Tony Zhang, the chief strategist at Options Play.